Hello. Let's go and look into how we can sell a bull credit spread or a bear credit spread. It's basically the same thing. One is on the put side and one is on the call side. We'll choose the SPY, which is the SPDR S&P 500 ETF trust, one of the biggest, most liquid things you can trade on the whole market. And we'll keep it simple. We'll choose the first monthly option chain we can find, which is the November 2020. We'll open it up and we'll take the first side of the example, which is the bull credit spread. Bull credit spread happens on the put side because what does a bull credit spread tell us? It tells us that my assumption is bullish. So we'd like to sell something high right now that given a few days after, it will lose its value and we can buy it back and close the position at a lower price. And we pocket the difference. We make some money. How does this work? And why is it a spread? The first thing we have to realize is these kind of products, the SPY that I'm showing you right here, are very capital intensive. So to trade naked and not using a spread on this will require you a lot of buying power. I'm just giving a rough example. For a 40 delta put, I have to put up $6,375. However, what we can do to basically get more capital efficient is to buy our risk back. So instead of having, let's call it unlimited risk to the downside, in this case for the puts, basically we'll start losing money if it goes too low. We're gonna buy back a big portion of our risk by choosing a lower delta, and this is the column where you can see the delta, a lower delta strike price. We'll just go with this example right here. We'll just sell the 342 and buy the 340, and we'll see here that from previous, when we had like 6,500 in buying power requirements, we now have 141. Why is that? Because our max profit also decreased. So the difference in between what we're selling right here and what we're buying right here to limit our downside is 59 cents. It's $59 because it's always 100 100 stock of SPY, and that is $59. So our spread is 342, 340. So our spread is $2 wide, and we stand to gain the difference between the sell price from the option we're selling and the price at which we're buying the put that limits our downside. Without further ado, this is the bull credit spread, and it's super easy to understand. Nothing too fancy about it. It's not as easy to manage as a naked put, but it's the bread and butter of a lot of traders out there in the market, and it's a really solid strategy if applied correctly and if it's correlated with your risk tolerance as well. So let's delete this and see what a bear credit spread is. It's basically the same thing. We're gonna go, however, on the call side, and we're going to choose a delta. I'm gonna go with 30 delta, 360. Strike price, it's right here. I'm doing the same thing, but I'm doing it on the call side. So I'm gonna choose a delta to sell, and then I'm gonna look at a lower delta and limit my upside potential this time. So in case SPY price rockets to the upside, I'm limited. I cannot lose more than I have as max loss right here. So it's basically, again, it's the credit we collected minus the spread in between the two calls that I'm selling. Again, it's a $2 wide spread. We're collecting 60, 70, 69 cents, 70 cents per stock, per stock, so it's $70. and our max loss 132, 131 is our buying power requirement as well. Really easy to do. It can be, like I said before, your bread and butter, and you can do this for a long time and increase your revenues. So thank you for watching, and hope you enjoyed it.